Hillary Sunderland, and I'm the Chief Investment Officer of Beacon Wealth Consultants. And this is your December 2020 market update. Well, if last year I would have forecasted a global pandemic that resulted in national lockdowns with far-reaching health, social, and economic consequences, while markets continue to reach all-time highs, I probably would have been quickly dismissed. And yet that's exactly what happened in 2020. 2020 changed us and society in many ways, and there was a choice set of words and phrases that were used to describe the moments we all found ourselves living through. A research firm recently looked at the most used phrases in corporate earnings call this year, and you probably won't be surprised to see the one with the biggest jump. The use of the word unprecedented was, well, unprecedented. And the other phrase that had a drastic jump in usage was the phrase, "you're on mute." And I think these two phrases explain a lot of what happened over the last year. COVID ushered in an acceleration in the digital transformation of the economy. And this led to a situation where what you owned in your portfolio was even more important than usual. Sectors such as energy and airlines were down considerably in 2020, while online retail, technology, and home improvement had stellar double-digit gains. And these returns are directly related to which areas of the economy were most affected by the pandemic and whether or not that sector had the ability to employ social distancing or not. This chart shows changes in consumer spending in some sectors, with dark green showing the largest increases in spending and the dark red showing the largest declines in spending. And you probably won't be surprised to see that the greatest increase in spending were in venues such as discount stores, grocery stores, and stay-at-home entertainment such as video games, while sectors such as airlines, cruise lines, and movie theaters saw dramatic drop-offs in spending. For example, movie theater spending was down 99% year over year in March, and is still down 85% year over year in November, reflecting extreme stress for these lines of businesses. And these extremes led to a wild ride for the stock market. We have a correction, which is defined as a drop of at least 10%, approximately once per year. And of the drawdown since the 2008 financial crisis, this one was very steep and enough to be classified as a bear market. The March decline of almost 34% was one of the sharpest and fastest declines in history, as a collapse in the price of oil, supply chain interruptions, and stay-at-home orders combined to usher in immense volatility, a bear market, and a recession. And it's somewhat remarkable that the market ended the year as high as it did, but massive fiscal stimulus and measures enacted by the Federal Reserve to shore up the economy led to a very quick recovery for the stock market. This chart shows the maximum intra-year decline for the stock market in every year since 1980, try the red dots there, and the annual return as of the end of each year in the gray bars. So since 1980, the average intra-year decline for the market is 14.3%. And despite that, 75% of the time, the market still ends the year with positive returns, which is why we often tell you to not panic when the market experiences a pullback or a correction, because this is quite common and it's a normal part of investing in the market. But the really interesting thing about 2020 was not only how far it dropped so quickly, dropping 34%, but also how much the market rallied from its lows in just over 9 months to end the year at an all-time high. For the calendar year 2020, large cap domestic stocks, which is the yellow bar there, the S&P 500 index, was up 18.4% when dividends are included. Small cap stocks, which are the smaller companies in the United States that are publicly traded, were up 19.96%. International developed stocks returned 7.82%. Emerging market stocks had a great year, returning 18.31%. The Bloomberg Commodity Index, a lot due to the drop in the price of oil, was down 3.12% on the year. And the fixed income markets also posted positive returns, with the Barclays Aggregate Bond Index up 7.51%, with a lot of that coming in the first quarter of this year. High yield returning 6.17%, and emerging market bonds also having a positive year, returning 5.26%. So 2020 turned out to be a very good year for investors, despite the extreme market volatility that we witnessed in the first quarter. Now, quite a bit of the market rally came in the fourth quarter as election risk faded and there was positive news on the vaccine front. And the market is forward looking. So even though we are in what may be the depths of the COVID crisis right now, the market is anticipating what things will be like 6 months from now. So as part of this 2021 outlook, I wanted to take some time to talk about COVID. This chart shows current US hospitalizations, and the effect of COVID on the economy has not as much to do with case counts as it does hospitalizations, because the renewed lockdowns we are seeing, such as those in California and abroad in the UK, are focused on the ability of the healthcare system to handle the crisis. We've seen a large uptick in hospitalizations during this current wave of the pandemic, as shown here. And this has led to immense strain on the healthcare system in some parts of the country. This chart shows inpatient occupancy rates by state over the last year. And the gray bars indicate the occupancy range, and a purple line on each bar there shows the current occupancy rate. And it's important to note here that hospitals work very similarly to the hotel industry in that they are staffed for occupancy of 80 to 85%. So 80 to 85% is really hospital capacity, not 100%. So as regions get closer and closer to that threshold, lockdowns can follow like they have in California. And from a demographic perspective, those 65 and older are more likely to require hospitalization. As shown on this chart, while those aged 65 and older account for 16.5% of the population, they account for over 80% of the fatalities so far. And because the vaccine distribution plan is largely focused on this demographic, we should see hospitalizations come down considerably over the next 3 to 4 months as the vaccine is distributed to the population. Over time, this should reduce the incidence of lockdowns and their severity, and hopefully allow us to return to a more normal economy in the latter half of 2021. Now, remember that the market is forward-looking, so if we expect the vaccine rollout to allow us to return to a more normal environment by summer or early fall, and we continue to have the backdrop of low interest rates and fiscal stimulus, which is the base case given the election results, this is a favorable market environment. Now, if the vaccine rollout continues to move slowly, or if a new variant of the virus becomes widespread, that could change the shorter-term outlook. But for now, that is the base case scenario, and that is what is behind the market rally. So even though we are in what hopefully is the depths of the crisis, and that things will get better from here, even though case counts are up so much and hospitalizations are up so much because of the outlook for the vaccine distribution, that is really causing the market to rally, which has led us to the question, is the market overvalued? Now, I would say that there are parts of the market that are overvalued, but remember that as active investors, we aren't necessarily invested in those areas. Because COVID accelerated a digital transformation in the economy, investors dove into some of the largest technology stocks in 2020. So much so that just 10 companies in the US account for almost 30% of the stock market returns of the S&P 500. And as shown by the green line on the left-hand chart, those top 10 stocks have been bought up so much that they are looking quite expensive compared to the other 490 stocks in the index, which is the gray line there. So when you're a passive investor, an ETF or mutual fund, you are betting that those top 10 names will continue to perform well. However, we are active investors, so this isn't as much of a concern for us. Right now, we are seeing a very wide range of opportunities. And additionally, remember that we invest globally, and other areas of the global market, such as emerging markets and developed international stocks look very attractive. And so we've been buying those areas opportunistically. Looking ahead, the Federal Reserve reaffirmed its commitment to maintain low interest rates for the foreseeable future, and the passage of an additional stimulus bill should help alleviate fears about permanent economic scarring and provide markets with a solid foundation to kick off 2021. If the vaccine rollout goes as planned, we should see the beginnings of return to normalcy by mid-year, and the reopening of the economy should provide those sectors most geared to economic activity an opportunity to outperform. However, there are some risks to our outlook. Obviously, COVID is one of them. So a new COVID strain taking hold in the US or a slower than planned vaccine rollout or uptake could stall the recovery. With the shift to the Biden administration in January, another round of stimulus might be forthcoming. However, that looks how that looks will depend largely on what can get through the Senate. While Democrats may end up in control, it will be by a very narrow margin, and how moderates vote on policies will be very important. Down the road, one of the risks I see is that the US needs to figure out a way to finance all of the spending. The amount of money the government has spent so far has caused an explosion in federal debt, as shown on this chart. We are now at levels not seen since World War II, when the government took on a tremendous amount of debt to fund the war. And this could cause inflationary issues down the road, which is something we're watching closely, is how all this will be unwound over the coming years. As always, we will continue to review economic and market environment closely, and will make changes to the portfolios as warranted. We thank you for your continued confidence, and please reach out to us with any questions that you may have.